Today we're gonna go visit a client. See, during the closing process, I've got a team. Sometimes I don't get to meet everybody, but I do my absolute very best to meet as many people as possible. So today we're gonna go visit Daniel, who just got his keys this past month of August. We're gonna surprise him with a little gift and also meet him in person. Come take a ride with us. So now that we're on our way to go visit this client, which I'm really excited to see, let me tell you what I'm seeing in the marketplace as far as what activity I'm seeing on mortgage rates and what activity I'm seeing as far as home values. So let's start with mortgage rates. So this year, it's news. It's commonly known that interest rates have gone up to historical highs. And it's definitely been a roller coaster. We've had some good days, we've had some bad days. That's just the way that the market is. And here's the latest thing that I saw change. All year we've been kind of, doing this, but trending upwards. And then in July, rates went over 7%. And they have stayed over 7% since July, reaching a peak of 7.49% in August 22. So we're 9 months into the year. Rates have gone up as high as 7.49 on August 22nd. And then they've come back down as low as like 7.06 and then 7.2, and they've just been bouncing around between that 7 and 7.49%. And this is, by the way, national averages for someone that has good credit, meaning a 740 credit score. So, needless to say, market volatility continues as far as interest rates. However, here's something really interesting. When interest rates go up over 7% like we're seeing right now, I generally see three reactions. So one, I see some families that unfortunately, because now the money is more expensive to finance, they no longer qualify for the amount that they want. So then what ends up happening with this group is they stop looking, because maybe they qualified for $400,000 if the rate was in the sixes. Now if the rate's in the sevens, now they may not qualify for $400,000. They'll still qualify, but it might be a less amount and not for the amount that they're looking for. So then those families stop their search. But then you've got a secondary reaction. Then you've got the people that do qualify with the 7% interest rate, but then now they get kind of freaked out and they're like, you know what, the news says I shouldn't do this. My mom, my dad, my uncle, whoever says that I shouldn't do this right now. So then they walk away from the home buying and now they stop their search. And then there's this third reaction that I see, which are the people that no matter what, they want to become homeowners. They believe in the long-term value of what real estate can bring to them. And that group of people is still keeping the market moving, because we're still seeing homes being sold even with interest rates the way they are, because this group of people wants to be homeowners. And the cool thing is, since the other two reactions happened, both of these groups dropped out of the race, then now it opens up opportunity for the group that does want to become homeowners to be able to negotiate. So let me elaborate on what I mean with that. So now and then, if the home was going, let's say, for $500,000 and you offered $500,000, depending on whether that home had a lot of activity as far as offers or not, let's just say it did not have any offers and it's been sitting for a couple of months, then you might be able to go in, make an offer, and ask for a dollar amount credit. Maybe you ask for, $5,000, $10,000, $15,000 for your closing costs. And the beauty with that is that no matter what's going on with interest rates, whether they're up, they're down, now we can use some of these funds from this credit that you're negotiating through your realtor in order to buy you a below market interest rate. So that's the cool thing, that when this two groups of people get freaked out and drop out of the race, the people that do want to buy real estate, they get the opportunity to be able to negotiate and still end up owning a home with the payment that they feel comfortable with. So that's what we're seeing with interest rates. What's to come? Most everything I'm reading, and of course this is an estimate. Nobody can guarantee you what's exactly going to happen to interest rates, no matter who they are. Not even the Federal Reserve can guarantee you. So if you think your Uncle Bob can guarantee you rates, we're all guessing is the truth, because there's so many variables that can impact an economy that it's very unpredictable. But what most are believing is that interest rates are expected to remain at these levels through the end of the year, and maybe, if we're lucky, at the end of the first quarter of 2024, we might start seeing a gradual decrease, but it wouldn't be something fast. So we will see what happens, but that's what we got for interest rates. Now, when we move over to home values, something interesting there. Even though the demand has dropped, because I did mention a few moments ago that you've got this two groups of people that dropped out of the race, so less people looking for homes, we still have this unique problem where a very large percentage of would-be sellers, people that currently own their homes, that would normally be selling at this time of year are not selling. And the reason they're not selling is because they have really, really low interest rates. So they're really thinking twice about whether they want to sell currently, even though they have a ton of equity. But they're tied in. They're tied in with like 2%, 3%, 4% interest rates, and they're not very excited about selling. So because of the lack of inventory that this is creating, you're seeing home values kind of stay put. They're not really jumping up a lot, but they're not going down. They're kind of hovering around the current levels because people are still buying, just not at the same level. Now, some interesting things that we're keeping an eye on, and we'll see what happens further, is as people negotiate, one thing that is starting to catch up to us is appraised values. So back to the example that I mentioned, if somebody offers $500,000 to buy a home, but then they negotiate a $10,000 credit for closing costs, that's a good thing. That helps that buyer get lower payments, things like that. However, on the flip side of that, did that home really sell for $500,000? Well, on paper it did, but there is a negative adjustment of $10,000. It was really $490,000 that it sold for because the seller gave away $10,000. So that's something that we're starting to see, that appraisers are taking that into consideration when selling a home. If the comparable sale that was used to justify whatever sales price you're looking at buying, if there's a lot of comparables that were giving these credits, then now there might be a negative adjustment to that comparable, leading to maybe a little bit of a lower appraised value, which is normal. Like these things happen and have to be taken into consideration. So those credits are a double-edged sword. They help you on one end in order to complete a sale and get a lower interest rate and payment for the buyer, but then on the other end, it can affect the future comparables for the people that want to sell down the road. So double-edged sword. So there you have it. That's what I'm seeing. So we're pulling up here to visit this client. So let's go surprise him, give him this gift, and just show him his appreciation for his trust. Because when it comes to mortgage financing, this requires trust. It's a big, big decision. And we always want to do a good job of just being 100% transparent, showing you your options. And if you're comfortable and confident with your options, let's do it. Let's get you a home. All right, so we just got done visiting a client. It's always fun to meet everybody and take a look at their part of the world. So now you know what's going on with rates, market, values. We'll keep you posted. Have a good one. See ya.